Ladies and gentlemen, can I please have your attention?
In this video, we're going to talk about the Schwab Roth IRA and show you how it's possible to get a 43% return on investment like I'm doing here by investing with your Roth IRA. I'm also going to take you inside this account, share the fund and the stock holdings generate this return, and go over 3 easy, proven, and reliable ways to maximize your return on investment. Woohoo! Meet my friend, Willie. No, not that Willie. This Willie. William Roth, or as he is also known, Big Willie style, is a politician from Delaware. And in 1997, he wanted to do something to make it easier for everyday people to become millionaires and retire rich. So he proposed a new kind of investment account that would give everyday people the ability to earn tax-free wealth by offering new investors a massive advantage that was never before possible. They called it the Roth IRA. And a year later, it was successfully passed and is now one of the most powerful new investor money-making tools. A Roth IRA is simply a type of investing account, but with a very special tax advantage. It allows you to grow your money tax-free. The way it works is you transfer money from your checking or savings account into your Roth, and then just buy stocks or index funds from your Roth. And you have to make sure you're buying from your Roth IRA, because if you don't, you won't get the special tax advantage. The Roth IRA is also free to open, and you can open a Roth IRA account with almost any traditional brokerage or with most investing apps like Robinhood or WEBULL. I already walked you through doing this step-by-step with WEBULL in my video here, but my preferred brokerage is Schwab, which we'll cover in this video.
Well, Brand, why is it such a big deal? Why don't I just use a regular investment account?
You just make significantly less money, and that's really it. With the Roth IRA, as long as you follow the rules, and there are a few required rules, which we'll cover in a moment, you pay 0 taxes on your gains. That's 0%, which is amazing, making it much easier to turn small amounts of money into big amounts of money and generate tax-free treasure. I like that. It was recently revealed that entrepreneur and investor Peter Thiel was actually able to use a Roth IRA to turn an initial $2,000 investment into, wait for it, $5 billion. And of course, this was due to multiple factors, but the Roth IRA was one of the most important keys. So the bottom line, if you want to multiply your money and make it grow passively, it would just be silly not to take advantage of the power of the Roth IRA. So what are the rules? Here are the rules you need to know, at least some of them. Number 1, earned income. You can only put money into your Roth earned from a job or money earned from a business if you're a business owner. Pretty self-explanatory. Next rule, the max contribution rule. As of you can contribute up to $6,000 per year. However, like with many rules, there's an exception to this rule called a backdoor Roth or mega backdoor Roth, which is a way of setting up your account so that you can actually make unlimited contributions. Pretty cool. Max income rule. Max income rule is $140,000 for the tax year of 2021. But if you make more than that, don't worry, because like above, you actually get around this rule with the backdoor or mega backdoor Roth. Rule on withdrawals. You can take out your Roth IRA contributions at any time for any reason without owing any taxes or penalties, but withdrawing earnings can carry penalties. Now note, this is a brief summary and I am not an authority on this topic, nor am I a financial advisor or a tax pro, just a guy on YouTube. So consult the appropriate professionals and always please treat your investments with that TLC, 10 to 11K. I heart you. So how do you get one? You can open up a Roth IRA at any major brokerage, my preference being with Schwab. With Schwab, you just go here, click Open Roth IRA, and then you have to log in, or if you're new to Schwab, you'll fill out your info here and follow the prompts. And if you're already a member, you'll find most of the info pre-filled for you. Just enter your social security and click next. Once you do this, then you'll just transfer your money into your Roth account. And then from there are 3 different approaches: active, advisor, and passive. Active being active investing. Active investing is picking stocks yourself. It's fun and it's exciting, but you usually need some kind of inside advantage or information. And also the chances of getting a better than average return with this strategy is low. So there are major downsides. Here you can see the research shows it's extremely rare. Historically, even the professionals almost never outperform the market over time, and that's professional. So even lower probability with this option for individuals that aren't professionals. And another downside, you'll also have to do all the rebalancing yourself. It'll be your job to know when to buy, to sell, and to adjust. So it's definitely fun and exciting, but low probability and a good amount of work with this strategy. Number 2, advisor. This is using a financial advisor to manage your portfolio. And of course it makes sense. In some ways, they're a certified professional, right? But will they actually get you a better return than you could just on your own. Now, for some people, a possible upside could be having someone you can call for emotional support, but if you can get the same or similar result without paying the fees to a financial advisor, then is it actually worth it? Option number 3, passive. Passive investing is investing in an index like the S&P 500. It has the downside of being less fun and exciting, but the upside of being easy because, well, it's passive. You just invest in the index and the index does all the work for you. Plus, it also takes like literally no to little time, maybe 15 minutes a month, if that. Plus the additional upside of not having to do any of the rebalancing yourself because all that work is done by the index. And add to that, the additional upside of giving you a diversification across hundreds or thousands of stocks. So a lot of benefits with the passive approach. Now, I think it also makes sense to consider what fits your personality. That's important too, right? And I'm definitely, for myself, a DIY type of person, do it yourself, but I don't have a lot of extra time. So the strategy I prefer is option 3, passive investing. Now, when it comes to passive investing in index funds, there are many different types of index funds with reliable performance, like broad market index funds, international index funds, market cap, earnings-based, dividend-focused, sector index funds like REITs, socially responsible index funds, and even leveraged index funds if you want to get spicy. And the expected return for most index funds is about 10%, which is a good rule of thumb to use when doing comparisons of performance. I personally hold multiple index funds. I'm a big fan of them. However, there is one main index fund that is the majority of my Roth, and that is the Schwab 1000 or SCHK, a broad market index fund that holds 1,000 different stocks. They cover a broad and diverse set of sectors. So let's actually hop into my Roth IRA and have a look at the sectors and then the stock holding. 27% of the stocks are in information technology, 13% in healthcare, 12% in consumer discretionary, 11% financials, 11% communication services, 8% industrials, 5.5% consumer staples, and 2% real estate, and 2% materials utilities. Now let's have a look at the stocks held inside this fund, generating the majority of this return. As you can see, some of the biggest and best performing companies are in here. First off, Apple. This is generating most of the returns. As you can see here, it's number 1. Then you got Microsoft, and then Amazon, Facebook, Google, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan. These are the top 10 stock holdings, and as you can see, are responsible for 24% of the return being generated. If you're doing research for yourself, you can look up the stocks inside any fund by simply looking up what's called the portfolio holdings. Now, after you've chosen which of the 3 approaches you're going to use, next you'll want to consider what's called your risk tolerance and risk capacity. Risk tolerance being how much risk you can stomach, and risk capacity being how much risk you can actually afford. In other words, what amount is going to work for you.
But Bren, shouldn't I wait until I have more money to invest?
When it comes to how much, don't let thinking your amount is not enough hold you back. This is a major mistake you want to avoid. The Wall Street system is rigged to make the wealthy people more rich by making the people outside the system, like you or I, feel overwhelmed. The suits want you to be overwhelmed and confused so they can make money off you and charge you for it. The truth is, any number is enough as long as it works for you, and thinking there's some correct number that you need in order to actually get started with your Roth IRA, it's just not the case. I started with an initial investment of $8,895 and then started dollar cost averaging in from there on a monthly basis, but there's no right amount to start. The right amount is however much you have. You can start with as much or as little as works for you. And I think it's important to mention that it was not uncommon to do well in the stock market in the past few years, or even especially in the past year. Many people did, so these kind of returns are not unheard of. However, there are many more people that got an exactly 0% return, and those are the people on the sidelines who did nothing. Come on, man! There's a saying with investors that goes, time in the market beats timing the market, which means getting started by some amount is always the best idea because it'll give your money more time to grow. And just a reminder, the glory comes only after daring to begin. Getting a Roth set up and getting your money in the market that first time can be scary. I know this, but the Roth IRA gives you the safest and most painless experience for your first time. And it just makes it so gentle. So that Roth is the perfect way to just pop your cherry. Of course, thanks to our boy, Big Willie style. Now here are 3 ways to maximize your return on investment that are easy, proven, and reliable. Maximizer number 1. Opt for passive income. While active investing can possibly offer better gains at times initially, it is most likely that over time, passive investing will give you the best performance. Buying funds like SCHK from Schwab or VOO or VTI from Vanguard are all highly rated, reliable options. ROI maximizer number 2. Use DCA, dollar cost averaging. Now you may have heard of something called buy the dip. With this method, you only invest when the market dips in price. It's one of the most popular methods talked about a lot online, and it sounds smart because you're buying at a cheaper price. But is it actually the best way to maximize your returns? The other most common method is called DCA or dollar cost averaging, which is where you just invest a chosen amount every month, month in, month out, no matter what the price is, regardless of the price. Now buying the dip is smarter in theory. But let's check out a study with actual data. This study right here called a statistical test to get the best investment strategy, compared dollar cost averaging with buying the dip. And to do this, they ran the data and back tested over 100 years of data with 1,080 periods of 10-year investments. And in the end, they concluded the data showed that DCA consistently outperformed buying the dip. So not only is DCA likely the best way to maximize your returns, it's also the simplest and easiest method. So number 2 is use DCA. ROI maximizer number 3. If you wait, you'll pay. In this video, which I recommend you watch next, I calculate the actual opportunity cost of waiting. I compare 3 different scenarios. And as it turns out, starting just 2 years earlier, in one scenario we calculated would make you millions more in returns, which means waiting just 2 years, it would cost you $2 million in lost gains. So maximize your gains simply by starting sooner rather than later. And to give you some more juice, here's some dope quotes on motivation to get you moving. You may delay, but time will not. Procrastination is opportunity's assassin. You see, in life, lots of people know what to do, but few people actually do what they know. Knowing is not enough. You must take action. There are only 2 mistakes one can make: not going all the way and not starting. If you liked this video, make sure to let me know by hitting that thumbs up button. And if you want to see more and take our relationship to the next level, consider hitting that subscribe button so I can make more videos like this for you in the future. And if you'd like to sign up for either Schwab, WEBULL, or Robinhood to set up your Roth IRA and apply what you learned in this video, I'll include my affiliate link in the description below. You can easily set up your Roth at any of these guys. And given that I spend between 10 and 20 hours on these videos, sometimes more, using those links in the description are a great way to support the channel and say thank you. So thank you for watching and enjoying this video. And next up, I've got another video I think you're going to love. Check that out here, and I'll see you over there. Hey, you. What's up? It's me. Your conscience. Did you set up your Roth IRA yet? Do it. Your future self will thank you. It's a good idea. The longer you wait, the more it'll cost you. Invest in your future. It's worth it. You'll be happy you did, I promise. I love you. Oh yeah, and also, speaking of the future, buy some Bitcoin and maybe some Ethereum too.